analizar precisamente este contexto de mercado. Lo hacemos con la ayuda de Jay Kaeppel, Senior Research Analyst at sentimenttrader.com. Jay, hello. Thank you so much for attending us. So the S&P had last week its worst week since 2020. Fears of recession are increasing after the Federal Reserve raised interest rates another 0.75 of a percentage point and suggested more of the same ways to come in July. Treasury Secretary Yellen says she expects a slowdown, but a recession isn't inevitable. It's not the first time we heard this sentence. What do you think?
Well, I do believe we could have a recession, but right now the indicators that I follow are still essentially neutral. So we're going to have to wait to see. In terms of the markets, it's a very mixed market right now, and it's very difficult for investors. The most important thing that I keep telling people is the two questions to ask yourself: do you have a plan, and are you following that plan? Because in a bull market, you know, it's easy. Things are swell, things are great, everything goes up. In this kind of a market, having a plan and sticking to it is what's going to separate the winners from the losers. In the last several weeks, as you kind of mentioned, the market down so much, 11 out of 12 weeks here, we're starting to see some bullish oversold signals. In fact, I'm going to show you a couple in a moment, and also some bearish sentiment that is getting overdone to the downside, which is bullish on a contrarian basis. Still, however, if you step back and look at the big picture, where you have the Fed tightening, you have high inflation, rising interest rates, and poor price action, that's a very difficult environment for investors. So if I may, I'd like to show you a couple indicators that I'm following right now. I'm going to do this kind of crude thing where I actually hold a chart up to the screen. The first one we look at, the S&P 500 index, we look at the percentage of stocks in that index that are above its 50-day moving average. And right now, or as of last Friday, that number got down under 2%, which is extremely low, very oversold. So let me hold this up here and kind of explain it to you. If you look over at your far right, at the top, the price is the S&P 500 index, and then the big squiggly line at the bottom is the indicator itself. And if you look at the red dots at the bottom, that is where you had fewer than 2% of the stocks in the S&P above their 50-day moving average. So that indicates the market's very oversold. And if you look at the top where the S&P price action is, you can see very often it comes close to a bottom. One thing to note is very often indicators like this are a little early. So this is not a buy signal. What this tells me is it's time to maybe put a little bit of the bearishness aside and be looking for an opportunity, okay? Now, the second one is very similar. There's an organization called the American Association of Individual Investors, and they conduct different polls among their members. And one of them is very simply, are you bullish or are you bearish? Okay. And right now, the ratio of bulls to bears is extremely low, almost on a historic basis. So once again, it's the same kind of chart. The S&P 500 index is at the top. But if you look at the red dots at the bottom, it does not happen very often that you get this low of a percentage of people who are saying they are bullish on the markets. So this is another signal that says it's time to, especially for shorter term traders, to say, okay, maybe it's a time to be looking for an opportunity to play the long side of the market. The bearishness has gotten a little overdone. Okay, so that's the good news, okay? So now the bad news, American Association of Individual Investors, they conduct another study or another poll, and the question is, what percentage of your capital is in the stock market? It's a very different question. And typically in a bear market, you know, that number goes down, down, down. As the further down the market goes, the lower that number gets. Typically at a bear market bottom, that number will be between 40% and 45%. In other words, people sell down to the point where they have less than 50% of their capital in the market. Now, if we look at this chart, so again, starting over on the far right, and you see these cases where the market's going down and the allocation to stocks keeps going down because more and more people are throwing in the towel. They start to panic and they drop it. The number drops way down to 40-45%. Now, if you look over here at the far right where we are right now, that number hasn't budged at all. They still have an allocation of 67%. Now, what that tells me is that people are saying they're bullish. People are talking like, bearish. People are saying they're bearish. They're feeling bearish, but they're not necessarily acting bearish. They're staying in the market. And, as a student of market history, I can tell you history is very clear. Human nature never changes. Human fear and greed are what they are. And my guess is that before we get a true full bear market bottom, that number will be much lower. Okay. And I have one more chart. And this is really kind of a big picture type of chart. So valuation, we're talking about price earnings ratios, price to book value, et cetera. We're going to focus on price to earnings ratios. Now, the way that I explain it is valuation is not a timing indicator, it's a perspective indicator. And the way I put it is recession is the economic equivalent to jumping out the window. And the PE ratio essentially tells you what floor you're on when that happens, okay? A little crude, but entirely accurate. So this last chart is something called the Shiller PE ratio, and I'm going to show you, this goes back over 100 years. I'm going to point out the three highest readings. In other words, the three most overvalued periods in the market historically. So we will start over here in 1929. The Shiller PE topped out at about 33. In the next 3 years, the Dow Jones Industrial Average actually lost 87% of its value, and that was the lead up to the Great Depression. Now, if we fast forward to the year 2000, the Shiller PE hit an all-time high of 44. The NASDAQ in the next 2 years lost 83% of its value. And now, the second highest reading of all time occurred last year when this ratio hit 38. Price to earnings ratio hit 38. And since then, it's come down to only about 28. And so there's still downside risk. To put it into perspective, the PE ratio right now is 28. At the low in 2009, it was down to about 14. Okay, so now typically I show that to somebody and they kind of panic and say, wait a minute, are you telling me the market's going to drop 50 to 80%? That's not actually what I'm saying. What I'm saying is that's what's happened in the past, and typically bear markets play out that way. So there you have it, a little good and a little bad.
Okay, and what about inflation? We're waiting tomorrow for Jerome Powell. Powell has pledged to control inflation while maintaining a robust job market. Do you believe it's possible?
Yeah, the thing to pay attention to, here in the U.S. anyway, the consumer price index, historically, when it's above 4%, that's very bad for the stock market. It has a tough time getting going. However, when it gets above 8% and then goes lower from month to month, very often the stock market will perceive that inflation is peaking. So what happened in the last month is inflation was over 8%. The analysts were expecting it to be lower, and it came in higher, and that really threw the market for a loop. And that was a big part of the explanation for the decline that we saw in the last several weeks. The market needs to see some sign that inflation is going to peak. And the best way to do that is to tick lower from month to month. So that number won't come out for a little while, but definitely we'll be keeping an eye on it. And if it does come in lower, that could be another catalyst that most people would not expect to see thrusting the market higher, but I believe that it could.
And I want to ask you about some companies as well. Elon Musk says there are 3 issues to be resolved to complete his purchase of Twitter: fake accounts, debt financing, and Twitter shareholder approval. The fate of the deal has become more uncertain in recent weeks. Which do you think could be next Elon Musk's step?
Well, I don't know what's going to happen there. One interesting thing that I'll point off, sort of off the beaten path, a totally separate strategy, and I'll make this quick, but selling naked puts on stocks. A week ago, I wrote an article about selling a put option when Tesla was trading at about $630 a share. You could sell an out-of-the-money put with a 400 strike price and take in over $3,000. So I don't know what that has to do with Twitter, but it has to do with Tesla, and it's another way for investors to consider generating income in a market that's not treating people very well.
Mm-hmm. And what about Tesla? Tesla shares are up sharply today. Which can be the reason?
I'm sorry, I didn't understand the question.
Tesla shares are growing today. There is a special reason about that?
You know, I haven't looked at Tesla shares today. The one thing to keep in mind on that deal is there is a point. So the story, as I understand it, is he used a lot of his Tesla stock as collateral, or he's going to put that up as part of collateral for the deal. If that stock drops below a certain point, and it's somewhere south of $400 a share, theoretically, he could get a margin call. So there's a lot of moving parts in that deal, whether or not it'll even close. And then if it does, he's going to need those Tesla shares to stay above $400 a share, or it's going to become an even more interesting story.
And I want to ask you finally about oil prices are rising today on high summer fuel demand, while supplies remain tight because of sanctions of Russian oil. Which are your expectations in oil demand and price?
Well, I can't predict the price of oil, but I will say this. There's one of 2 scenarios that I'm looking at. Either supplies will remain tight and we could see a blow-off top in the energy products, crude oil and unleaded gas. I hope that doesn't happen, but it could. However, I follow a lot of seasonal factors, and I know that energy, particularly unleaded gas, tends to show weakness later in the year. In fact, between the end of, or I should say late July and early January, in the last 31 years, unleaded gas futures have declined 24 of those 31 years between July and January. So I'm hoping that that will be the case this year and things will cool off.
Okay, so Jay Kaeppel, thank you so much for attending us. Have a nice day.
Thank you very much for having me.